analytics are crucial for understanding companies. What role do market analysts play in the bigger picture? Here's a very special chat with Sanjay Bakshi.
I long ago decided to be a business analyst, which means that I don't really want to pay attention to what is happening in the markets. For example, money flows or SIPs or what the FIIs are doing or what the Indian mutual funds are doing and so on and so forth. Those are important factors for many people to be sure, but not for me. And those are important factors for determining what will happen to the near-term stock prices, but they don't have any impact on the underlying fundamentals of the business. So if your focus is on the business and not on the stock price, because you're training yourself to be a business analyst and not a market analyst, you have to do so many fewer things. The number of moving parts that you have to focus on, drop by, I think, 90%. So to keep things simple, I decided long ago to be a business analyst and not to be a market analyst. So, the question that you asked, how will money flows change and how will short-term behavior? Of course, we have always had speculation. It's not going to go away. And of course, I'm not happy about the idea that India is now running the world's largest casino in futures and options trading. And I do think regulators are right to control that because people have a propensity to gamble. And desire to become rich quickly is very strong. And I think even the founders of the platform Zerodha have disclosed that most day traders actually lose money, and the ones who don't lose money in monetary terms, most of them actually don't even beat the fixed deposit rate of interest. So it's an extremely competitive field with very high mortality rates, but that has not stopped people from getting attracted to it because you don't get to hear about the losers, you only hear about the winners, and people are attracted to that. So that propensity to gamble has to be sort of reined in, I think, through regulation, through taxation. So I'm all for that. But again, as an investor, I don't pay much attention to those things because I think if you focus only on the businesses that you want to invest in and to see if there's a mispriced opportunity out there, that's the only time when the markets become important to me.
Professor Bakshi, mathematically, we know that good businesses are hard to find and great businesses are even tougher. And very few companies genuinely can really compound and create a wealth. So when you look at investing or when you look at identifying a company or a theme or an idea, what is the starting point? How do you start?
It's a good question. Again, there could be many starting points, but one very frequent starting point for me has been astonishing financial performance in the past, going back long into the past, which means that you automatically exclude businesses which don't have a long track record. And I think that's important to recognize because then you can see what happened to that business during stressful periods. COVID was recently a stressful period. I think it was a great environment during which you could study, businesses that have survived and thrived, and those who sort of were completely evaporated or eliminated from the so-called gene pool. So to study businesses and see how they have done during tough times gives you some idea about what is called as the Lindy effect. I'm sure you're familiar with that. The longer a business has been around, the more conviction one gets about its ability to survive and thrive in a tough environment. It could come from many factors. It could come from a variable cost structure. It could come from a strong balance sheet. It could come from diversification across various product categories. It could come from many sources. But if you really study especially in some sectors, in cyclicals, in financials, if you study, so there is a lot to be said about studying survivors. So when you see that astonishing financial performance, especially during tough periods, and you start looking at the inherent strength of a business, and you start asking questions to why did this business thrive in an environment where others were sort of being eliminated. When a bear market comes, or when there's some macro factors, or when there is volatility caused by with the help of the spread of technology, where manias can spread very, very rapidly. When that happens, then the market has the propensity or tendency to sort of paint everything with the same brush or to throw the baby out with the bathwater. So when that happens, even great businesses, which may be hard to find, as you mentioned, and but you know that they exist, but they're just not attractively priced. They tend to become very attractively priced during those periods of time.